Welcome to Beyond the Policy, the podcast where we go past the fine print and into the real stories that shape how we live, work, and protect what matters most. I'm Matt Karaffa, risk advisor, consultant, and founder of the Be Better Foundation, where each week sit down with clients, colleagues, and industry voices to talk about business, life, and the passions that drive each of us and the areas we can all work on to truly be better. This is Beyond the Policy. All right, Steve, thanks for joining us with Rust Belt Capital. So before we get into things, let's just give us a brief update what you've been up to with Rust Belt, and we'll get going.
Sure. So Rust Belt Capital is a multifamily investment company. We buy properties that are 50 units to 150 units at a time, primarily in the Midwest. Specifically right now, Northwest Ohio is what we're focusing on. A lot of the stuff that we buy is what we call workforce housing. A little bit older in vintage, not the Class A luxury that you see, but we find that's an attractive investment opportunity the last couple of years.
Yeah. You and I have spent a lot of time talking insurance on a couple of the deals, but maybe before we get into some of that, what's Rust Belt's philosophy when it comes to multifamily housing, and maybe that's something that might differentiate you than a lot of the other property portfolio managers that are out there?
Yeah, so Rust Belt Capital is very unique in terms of our hold period. A lot of times when you go to other investment firms that operate in this space in multifamily, their goal is to turn and burn, right? They want to buy a property, they want to push the value as much as they can, and then they want to sell it typically within 3 to 5 years. Our philosophy is we want to create perpetuities, or I like to call them ATMs, that just continue to pay cash dividends to our investors. Reliable, kind of like pension-like income that they can depend on. And so our hold periods always, when we're underwriting, go to 10 years. But the intention is to hold the property longer than that and to return money to investors through dividends and then through cash out refinances when the properties can afford it.
Yeah, makes sense. I know you and I got into the weeds on some of that stuff, and another thing I think is unique when you talk to some others, a lot of different geographical factors that go into it. You're specializing in Northwest Ohio, which isn't a Chicago, a Dallas, something
So
where you see
tertiary market.
Yeah. So what do you see? How do you see that impacting deals that come available, or when you look? Because I'm assuming it has to be kind of the right fit geographically.
Yeah. So I mean, we're open to a lot more markets than just Northwest Ohio. Northwest Ohio, to use the jargon in the industry, would be a tertiary market. And the reason tertiary markets are probably going to return or give a better return, especially right now, versus a core market. A core market would be like Columbus, Ohio, maybe Dallas, Texas, Miami, Austin, so on and so forth, is, you have a lot more competition, right? And some of that competition's very, very shrewd, they're very smart, and some of the competition's really dumb. And they'll overbid on properties, and then 4 years later they're losing it, and they go REO, bank owned. We're seeing a lot of that right now in the market. But for our investor base, high net worth individuals that want that stable recurring income, the markets that we're operating in, we have a lot less competition, so we can usually get stuff bought at a better price per door relative to rents, and get a higher return on it.
Yeah. One thing you probably underwrite a lot more deals than you bring to your investors. So just for context, how many deals you think you look at versus you actually put a real number bid in?
Yeah, so last month alone we looked at 49 different deals.
1 month, 30 days.
49 different deals. Of those that made it past the first initial look. So initial look comes to you, comes across your desk. You look at the OM, and then you look at the area that it's in. You need to know stuff about the area. So we look at stuff even in Dayton, Cincinnati, Columbus. But then, okay, is this a good area? Okay, if it's in northeast Dayton, not a terrible area, but not necessarily a desired market or sub-market of Dayton that we want to be in. If it's in Centerville, which is South Dayton, love Centerville. There's two big properties that came across their desk, 200 plus units apiece in Centerville, something that's very appealing. Definitely would pencil it more. So then the second phase is, okay, we like the area, we like the asset. Let's actually go run the numbers on this thing. Okay, here's what the numbers look like. Engage with the brokers, see what guidance is, and then go from there. If everything seems to go correctly to that point, then we put a bid in.
Yeah.
But we look at so many more deals than we do, and then we bid on a lot of deals. And I mean, this year I think we bid on 3 or 4 deals, and we've only gotten one. So.
Yeah, part of the game, numbers game.
Yeah, frustrating, but at the end of the day, we put our own money in. My partner and I at Rust Belt Capital, we put our own money in every deal, and we're not going to do a deal that we wouldn't do 100% with our own money, which is something when we go to sellers, we say, hey, yeah, we have an investor base, but we would do it without the investors as well. So.
Right, I think that's a differentiator of what I know of both of you and the company and how you've built it. Is there's a lot of others that are seeking money from investors, but they're not putting their money where their mouth is, which I think is a huge strength for you and Rust Belt.
Yeah, it's called co-investing, and then we get it. Basically, it's like a brokerage fee that's very, very common. When we do an acquisition, we take all the money that comes from that acquisition fee, and we just roll it right into the project. We don't see it, and we see it in dividends.
Yeah. So if we take, one of those deals that got to the table, further pencil, and again, where our conversations have been sometimes of, when you're cash flowing it, seeing how it looks, insurance is becoming more and more of a line item that you need to pay attention to. So when it comes to your property insurance, when you're underwriting a deal, what are some of the things you look for when you go through that process?
Yeah, so part of our investment, philosophy is we're extremely risk averse. We like to cover all our bases. We don't want to have open-ended questions or variables. So interest rates, for example, we lock those up, fixed rate, as long as we can, do it and make sense. And insurance is another thing that's been very tricky recently. 4 years ago, insurance was, kind of a second thought. Now, whether it's us or other operators, insurance is a huge factor, with premiums sometimes doubling, right? So it's definitely something we take into consideration and, make sure that it's right estimates that we're using in underwriting. With that said, the important thing with insurance is just making sure you have the right coverage, right? There's you can buy crap, but then you got crap, okay? If you're looking at a $5 million, $10 million, $15, $20 million property, do you really want to insure it with crap? Even if it's a tired property? No, you don't want to do that because something bad happens, you don't have the right insurance, then you figure it out afterwards, then you're hosed. Right, so
it's not good for you, investors, anyone at that point. It might be good initially, when you don't have a claim, but as soon as you do, now you're calling, investors back. You're having conversations that you don't want to have.
Yeah, don't save a penny and lose a dollar. And keep your eye on the dollar, not on the penny. And too many people want to do the penny thing.
Yeah, I think we've had a few examples of, when you're talking to the seller, of they might have owned it for 30, 40 years. And have had insurance with the same thing, and it might not have changed. It's hard in this market to say what the reasons were, but I know there's some you brought and say, hey, the sellers are telling me they're paying X, and I'm looking at it from a cost per square foot basis saying there's no way. And we dig into the weeds, you provide some details, we get an estimate, ran by our companies and give you not an exact number, but at least a range that you can underwrite with and move forward. Because if you just look at the premium number, we've talked about this, I can make that number say anything you want it to be.
Yeah, but then you might have crap, right?
Exactly.
And that's going to be the deal that has an issue, and then you need the insurance, and you don't have the insurance. Yeah, there's deals that we look at, especially older ones, that they have insurance that's way low, like way low. And whether we're trying to buy it, and trying to justify it and tell them, hey, your insurance might be nothing, okay, but whether it's us or somebody else, the insurance is not going to be that.
A new purchase, new ownership, all of that's going to trigger underwriting Because there's a very slim chance that whoever's insuring it at that point is going to just roll it over
So
to a
there's
new ownership.
there's companies. Okay, so great example of this, State Farm. State Farm doesn't want to cover multifamily anymore, at least in the state of Ohio. Okay, so there's been a couple properties that we've been bidding on, and we tell the broker, we tell the owner, we're like, hey, State Farm doesn't cover this anymore. They're honoring you because you're a legacy customer, but if we were going to buy this 1970s asset and try and put it with State Farm, we'd have to go install sprinkler systems. Okay, are we going to do that? That's going to be half the cost of the property. Like, no, we're not going to do that.
Right.
Which is a polite way for State Farm to say, we don't want your business, which is fine. So you got to go elsewhere.
Sure.
And then you see what the actual market is, and it's like, okay, you were paying, 2 popsicle sticks and a piece of tape for your insurance, and we need actual money.
Right. So I know, like, obviously when we talk on the investing, side of being a part of some of the deals, one of the benefits I like of knowing you and having that relationship is I know you take care of all that. You look at all those, that you're not going to short any corners to make a quick buck and make it look good on paper to get investors. You do it very conservatively, in my opinion.
Yeah.
And I think you would say the same. So even if you have a terrible year, everything goes wrong, that's how you planned it.
Yeah.
That's how you underwrote it.
Yeah.
And then when it's not and it's a little better.
Yeah. You account for the bull crap that's going to happen, and make sure that that's accounted for ahead of time.
Yeah,
for sure.
So speaking of that, all right, so kind of walk through the deal, how you put it together. Obviously, there's multiple other things that go into that, but let's say you get it. What are some operational efficiencies, that maybe you recognize in the underwriting that once you get it under management, you can start implementing that are able to increase cash flow and those type of things?
Let's real quick on the insurance topic. Okay, so the way we run our shop, we really don't want to use insurance unless it's a catastrophic thing. So it's managing claims, right? And you're like, why does that matter? I got insurance, I'm going to use it. The answer is that's probably not a good philosophy to have. Why? So in our business, we're always looking for new deals. We have more than one property. We've got a lot of properties, right? And so if we all of a sudden start getting claim after claim after claim after claim, now not only we might, save a penny and get something fixed or whatever, but then our premiums go up, or they don't want to insure us. Other insurance companies start asking questions. Hey, when was your last claim? When was this? When was that? And all of a sudden, our future deals that would have penciled don't pencil because we're in a really competitive environment right now. So what can we do to mitigate that stuff? Okay, you have 65 units on one property. You have something happens to a unit. Okay, maybe it's claimable. You can call your insurance agent and be like, Matt, we need a crap ton of money to fix this. Or, okay, you already budgeted for it. Just take care of it. Be a big boy. Put your big boy pants on, spend the money, and take care of it.
Right.
So that's something we do. Another thing is having a higher deductible. We like to have pretty high deductibles because we know we're going to do that anyways. So why not get credit for it with a lower premium? That'll bring your premium down. And then you just account for that stuff. That way we have basically catastrophic insurance. We're paying for that. Loss of income, stuff like that.
And a lot of those things are heavy properly driven, which is going to be your weather, your fires, those type of things. And obviously, we haven't touched on much. It's all factored into that, but liability of having that many units of liability issues that could come up as well, which is all factored into that. So, but a lot of our discussions that we have is around the property just because of the rate environment and all the underwriting changes. You mentioned State Farm. We have a slew of others that are just managing what they're doing with multifamily housing. If they're insuring it all, these are their requirements, and every company is different. And that's what we, have lots of discussions about. And, I appreciate your consistency across all units to tell that story that it's very consistent in what you're trying to do as a company. So that helps.
Yeah, for sure. What was the question that you?
So when you get into that, so say you're owning, you're operating. We talk about some rent buyback or utility buybacks and some other operational efficiencies as you grow in total number of units. So some could be, per deal, but some as you grow as Rust Belt. What are some of those operational efficiencies you're able to take advantage of?
Yeah, so let's talk about what the perfect deal looks like. So the perfect deal for us in that buy box of 50 to 150 units, owned by an owner that's owned it for a long period of time. They don't have utility bill back in place. They're in an area that it's legal to do because you got to know your jurisdiction, right? So some areas don't let you do that. So you got to figure out a way to come up with a different solution, right? The rents are lower than they actually need to be. They took pretty good care of the property, so it's not massive capex that needs to happen out the gate.
Right.
And then they got heavy operational expenses on stuff that's not realistic. Like they might have 3 staff personnel for a 100-unit property, and it really should be 2. Okay, well, there's probably a $70,000 gain right there that you can get by reducing the staff or taking that person and putting them on a different project, different property. Utility bill back, okay, so they're paying $1,000 a month for a 1-bedroom, but the landlord or the owner, which is us in this case, covers the utilities, water, sewer, trash. Why are we covering that? It's a consumable item that they're using. We just pass that through back to them, and then we have reduced that expense item on our P&L, and so we've netted that out, and that money flows back to us instead.
Yeah.
And it's very fair. If you own a home, you have to pay your utilities.
Right.
So that's something we do. The other thing we do is forced place insurance or forced place liability coverage on residents. As you get bigger, this is something that's super common in the business. It's not necessarily a profit center for us. It's more of a reduce our risk and cover the overhead that it costs to implement this. So if it costs us $8 a unit per month, then we charge the resident $12. That $4, we're not trying to get $4 from you. It's not
right.
Doesn't matter, but it covers the cost of implementing at the time, overhead and labor.
Yeah, and that plays into what you mentioned earlier with the catastrophic. There's a lot of things that could happen from tenant negligence. The common ones are leaving the stove on, some sort of cooking, popcorn in the microwave too long, stove on, candle burning, all those things that are tenant negligence that you as the property owner would be responsible for. But with you guys taking the next step and providing tenant liability, that builds in almost like another deductible in there, that we have a policy in place for all the tenants up to $100,000 that if they're negligent, that buffers between what your policy would ultimately pay versus what's going to be covered by a different set of insurance, which I think, again, sets you apart from what you guys do.
Yeah, I mean, that helps us justify higher deductibles, right, and lower premiums, so we can run the property more efficiently. It's just about being smart, and that's something that, if somebody's like, why don't I just go buy a quadplex, which is 4 units, or a 10-unit building, or a couple houses, or something like that, instead of investing with us? It's like, you can do that. Are you going to make more money than investing with us? No. Highly, highly doubt it. Not only you're going to have more liability, because when you invest with us, your limit loss, or your loss limit, is the money you invested. Versus you go buy a quadplex, you have to personally guarantee the loan. Instead, it's me and my partner that personally guarantee the loan. So Rust Belt Capital personally guarantees it. The investors don't. So if everything goes sideways, the world
you're
comes.
Out your investment.
Yeah, you're covered by that. And we have these systems and things that we're implementing, like the forced placed insurance, that you're not going to do for 4 units, right?
Right.
I don't think you can. Yeah.
Right. So that's one thing, you've hit on. One of the questions I was curious about is, what's a misconception or something that's just not true, when you talk with investors that, you're trying to invest in, Rust Belt, that I would imagine that would be one. Well, I can just go do it on my own, probably towards the top. Any other misconceptions you hear from your side when you're talking to new investors that you want to address here?
Yeah, so a lot of people worry about it being risky. Okay, it is an investment, so there is risk, but it's not any more risky than putting money in the S&P 500. And as a matter of fact, I'd say it's less risky than putting it in the S&P 500, because you can go feel it, touch it, smell it. It's an actual asset. It's not going anywhere, right? We insure it too. But you go buy a company that's traded on the S&P 5 or on the NYSE, and it's in the S&P 500, but it has revenue but no profit. Okay, tell me what the deal is there. How valuable is that? Yeah, you might get a unicorn, but there's a lot of times those companies go bust. Like Open Door, that's a new one. They're publicly traded. They have no profit. They have never made a profit, but they flip houses or whatever all across the country, big platforms, stuff like that. Okay, they've been in business for a while and they've made no money, but you're going to put money into that?
Yeah.
I don't know.
Yeah. A lot of different avenues down there, but I would imagine you see
And then
all kinds of things.
I would say another thing too that people don't get, okay, why invest with us versus going and doing it on your own? If you go buy a house and you raise rent by $100, did the value of your house increase? No. What's an extra $100 a month going to do in your life? Nothing. Literally nothing. Okay? You buy into one of our properties that we're buying. There's 60 units. Okay? We raise rents by $100. What happens? The value of that property just went up by over $1 million. Okay? It's called a multiplication effect. You only get when you have sizable numbers. Okay? So you have that advantage when you're with us versus you don't on your own.
Yeah.
We do cost segregation, which is when you buy a property, you hire a CPA firm and an engineering firm. They come in, they follow the IRS tax code, and they go and accelerate the depreciation on everything that's in there. So you go buy a property for a couple $1 million, you're going to get accelerated depreciation year one, which is a paper loss. It's not real,
Right.
but you can use it to reduce your tax liability. And there's all nuances to that. But you can't do that when you buy a single family house or a quadplex because it's cost prohibitive. It's
Right.
expensive to do that.
Right. Yeah. What's one thing, there's a lot of stories out there where investors aren't getting dividends or paid back, or they're holding on too long. What would you say a lesson you've learned in your, Rust Belt career of protecting investors' money?
Treat it like it's your own. Treat it better than your own. I'm always more nervous about investor money than my own. Always be honest. Tell the truth. If something goes sideways, make sure you tell them that. And do the homework before you're in the deal, right? The time to ask the questions is not when you close. It's before you close, right?
That's one of the things I love talking about you, because in insurance the same way. It's better to find out what you're covered for before it actually happens than to call and say, hey, this happened, and find out you're not covered. Same thing.
Yeah.
I'd rather get all the questions out up front, know as much as you can. Is there going to be something that pops up you didn't know, plan for, but you've accounted for in your underwriting, that if everything worst case happens, we're not going to pay you a dividend, but we're not losing money, and
Right.
we're not, your initial investment's never going to be at risk.
It's the unknowable stuff that'll kill you. So as long as you have a checklist, like there's so much stuff going on when you're doing an acquisition, you have to have a checklist and just go down the list, walk every unit. What are the things that we need to look in every unit? It's not just looking around, okay, cool, I don't like the carpet in here. It's what type of electrical box do they have? Because if you have the wrong type of electrical box, guess what? You can't get it insured.
Right.
If you can't get it insured, the bank doesn't like that.
Right.
Okay, that's a problem. Are there leaks? What does the plumbing look like? What type of plumbing is there?
Oh, yeah.
Is it copper, PVC, PEX?
Yeah.
There's another type of plumbing. I think it's like 20, 25, 30 years old. It's black, super brittle. Okay, if they have that in there, now you got to account for that.
Right.
Okay, what's the age of the HVAC systems? Are they in good condition, not good condition?
Yeah.
If they're new, what type of gas is in them? Because there's two different types of gas that have come out recently.
Right.
And they use different pressures, so it's not like you can just bleed the gas out and put new gas in. You have to put a new system in. So all this nuances and small things you need to know.
And that's one thing. It's in your investor emails and all of that. Of my number one thing of investing in Rust Belt is you're not getting any calls for plumbing, for ice, for snow, for lights not working. That's the best part, in my opinion. So.
Yeah, that's.
Thanks for handling all those.
Yeah, that gets old. That gets old real quick.
I think that would be at the top of the list of obviously investing money if you're willing to do that. This would be a very beneficial thing of knowing what's in the deal and thanks for sharing kind of what goes in your process of what's out there, because I don't think every portfolio managing company operates the same.
Yeah.
So it's good to get into the weeds a little bit.
And that's something that I'm super proud of with Rust Belt Capital. We've never missed a distribution payment. We've always paid on time. Like we get our K1s out to investors 15th of February every year.
Yeah.
Yeah, there's no not hitting that date. So
right. So we talked a lot of stuff about, Rust Belt, a little bit insurance, a little bit of efficiencies. So one thing, I think you've heard me talk about be better, suck less, all that good stuff. So if you had infinite amount of time where you didn't have to farm, you didn't have to underwrite deals, what's one thing that you would devote an amount of time to be better at?
Asking the hard questions, man. That stuff was easy, and now you ask me this question. I think it's engaging in relationships, man. At the end of the day, like, the most important thing in life is who you're around, what type of people they are, what quality people they are, how they push you to be better, and how you can push them to be better. That should be your friends, your spouse, or your partner that you're in a relationship with. And so I'd say that's where you should put the most amount of time.
Yeah.
Because it's who you know, not just what you know, right?
Yeah.
Like that's overly used cliche or whatever, but
true.
They find the right people and they get you to the right destination.
Love it. Last question. Favorite place you've traveled to?
Man, that's okay.
Or I can rephrase it. If you had a free plane ticket tomorrow, where are you going?
I like the first question, buddy.
All right,
so
fair enough. Favorite place you traveled?
Favorite place I've traveled. Dude, so I just got back from Lake Tahoe. Amazing place.
Okay.
You should go. But I don't think I'd say that's Glacier National Park, dude. I am fanboying over this place. All right, it's...
What month did you go?
I went in June, but you should probably go in August.
Okay.
Because the roads there's one road. It's going to the Sun Road. And if you go too early, there's either still snow and you can't get through, or there's a rock slide and they're repairing the road or something like that. But you'll go there, and I've never seen water so clear in my life. The mountains, there's no cell phone service, which is good. And you're like, this must be what the Garden of Eden looked like. Holy smokes. This is gorgeous, man.
Yeah. Awesome. So Lake Tahoe is most recent Glacier National Park favorite.
Dude, gotta go there.
Fair enough. Add it to the list.
Hope so.
Okay. Thanks for your time. Appreciate it.
Absolutely, man.
Thanks for hanging out with me on Beyond the Policy. If you got something out of today's conversation, pass it along to a friend, client, or colleague who might enjoy it too. You can always connect with me through the show notes or on LinkedIn. And remember, the best coverage always starts with the right conversations. Until next time, be better.